The joint investment meeting. Today is Wednesday, September 18th, and I will turn it over.
Oh, sure.
All right. Good morning, trustees. Welcome to the joint NYCERS and BURS investment meeting. Today is Wednesday, September 18th, and I will turn it over to Ms. Winery for the roll call. Thank you.
Good morning. Chair, Mayor's Office.
Nadia Fazulina for Mayor Adams.
Comptroller's Office.
John Dorsett, designee for Comptroller Brad Lander.
Public Advocate's Office. Borough President Manhattan. Borough President Brooklyn.
Karina Lozada for Borough President Antonio Reynoso.
Borough President Bronx.
Robert Moralia for Borough President Vanessa L. Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island.
Dan Master for Staten Island Borough President Vito Fossella.
International Brotherhood of Teamsters.
Lawrence Bosley for Julie Covey and Ruben Torres for President Greg Floyd.
Transport Workers Union. In District Council 37.
Robin Roach and my colleague Ray Santander, who's appearing virtually, on behalf of our Executive Director, Henry Garrido.
We have a quorum, and Alan Swisher, Dan Master, Ruben Torres, and Raymond Santander are participating per NYCERS video conferencing procedures.
Thank you, Ms. Vinery. With that, I will turn it over to Mr. Dorsa to lead the agenda. Thank you.
Great, thank you very much, Madam Chair. So we have a somewhat brief public agenda, which will include a commentary on the quarter from the Chief Investment Officer. I want to note that the risk report is in the materials. Rather than have a full risk report today, any risk highlights will be taken up in the comments of Mr. Meyer. And in the event that there are additional questions regarding either the risk presentation or the quarterly report, we're happy to make the appropriate staff available or answer any questions that folks have today if they feel that they haven't been answered during the presentation. So with that said, I'm going to turn it over to Steve to walk us through the quarterly performance.
Thank you, John. And good morning, trustees. It's good to be here. It's good to see everyone following what was a very short, it seems, and a quick summer. And I hope everyone had a wonderful vacation, some time off. I'm going to give you a quick update. I know that Kate is queuing up the slides in terms of where we are with the portfolio, but where we are with the economy as well. Actually, it's a handful here, so I'm just going to go. I'm going to just talk to the slides once you have them up. Maybe start as she's pulling them up. So obviously, a lot has changed recently. There's been a little bit of volatility in the markets. I'm happy to report, however, that the inflation dragon, both here and outside the United States, has been slain, and the Fed is in the process of pivoting to a more accommodative stance and a focus on unemployment rate. They have a dual mandate of maintaining price stability and promoting full employment. So I think they're shifting their policy focus today, and we'll actually see evidence of that. The Fed has a meeting this afternoon at 2 o'clock. They'll announce a potential change in policy. The market largely expects a minimum of 25 basis point rate cut, and the market, as of this morning, perhaps optimistically, is pricing in a 60% chance of a 50 basis point rate cut. Moving on to what would have been the next slide. Sorry, just giving Kate a hard time. Inflation, maybe just a jump ahead. There we go, Kate. Thank you. Thank you. CPI and core PCE are both below 3%. You can see on the far right-hand side, that's wonderful progress. CPI in white, core PCE deflator in yellow. So good news for the Fed and a job well done. Hopefully that we'll start to feel the benefits of their efforts in terms of a declining and lower inflation rate going forward. As I mentioned, the inflation dragon around the world has been slain. You can see on the next slide, both here and abroad. And you can see evidence of that. We are actually in the United States, we're charted in red. We're charted in red, and you can see that inflation's actually come down even further and more dramatically in the UK and the Eurozone. On the next slide, there is some legitimate questions that are raised, and I kind of touched on that when I suggested that perhaps the Fed may cut 50 basis points today. There's a concern that the Fed's behind the curve. If they've left rates and policy too restrictive too long, that may precipitate a recession at some point. Certainly that's been part of the concern. There was in August, there was a Jackson Hole Central Bank Symposium where, and I'll quote Chair Powell, Fed Chair Powell a couple times, he said that they're preparing for a policy pivot. He mentioned that the time has come for policies to adjust. The Fed Powell also clearly said that inflation has declined significantly. The labor market is no longer overheated. And finally, and again, paraphrasing him, with an appropriate dialing back of policy restraint, they should be able to maintain their 2% inflation target and promote strong labor markets in the United States. So again, expectations couldn't be higher for a minimum of 50 basis point rate cut today. We also get revised summary of economic projections of the dot plots, which I think will be also very interesting to get a sense for where does the Fed think Fed funds will be at the end of this year, but more importantly at the end of their easing cycle at the end of next year. As of the last dot plot in June, it forecasted a 225 basis point decline in rates. And if you look at that rate as being the neutral rate that either promotes a recession or and supports a stable level of employment, their policy is actually quite tight right now. So you could make a legitimate argument that they should tighten, ease more aggressively, but we'll see where that comes. On the next chart, this is a 10-year chart of unemployment, and you can see on the far right-hand side at the bottom, we have a 4.2% unemployment rate in August. That's actually down a little bit. It spiked up to a slightly concerning level for the Fed, a 4.3%. But again, the labor force participation rate in orange or yellow still is below where it was pre-pandemic. And that may have more to do with demographics and an aging population and reluctancy on the part of some of those key constituents not to return to the labor market. On the next slide, as I said, we've seen economic growth slowing as well, which again gives the Fed an opportunity to reduce rates. The Eurozone and the US is certainly slowing in terms of economic activity. We actually had a surprise GDP print for the second quarter of this year, going from 2.9% in the first quarter to fully 3.1%, which is above trend in the second quarter. Third quarter estimates are expected to be around 2.5%. And fourth quarter estimates for GDP growth are supposed to be probably low to mid 2% range. So that's about on trend. And we'll see where that comes. If I had to characterize the economy today in the U.S., I'd say it's cooling, certainly not collapsing. There are contrary indicators that also suggest a level of robustness. This actually looks at economic growth, and again, when I look at this, my key takeaway is the amount of volatility we saw in GDP growth around the world associated with the pandemic and how disruptive that was. We're still in the process of repair. You can see on the far right-hand side, U.S. economic growth, 3% dialing perhaps back down to 2.5%. In China, which is struggling a little bit due to a number of issues around property valuations, a high level of unemployment, youth unemployment, concerns about shadow banking. Their growth rate is probably well below the 5% that they were targeting. And if you look in the UK and the Eurozone, it's pretty flat in terms of economic growth. So again, the economy, both here and abroad, is slowing. And policy measures are being taken to address that in terms of rate reductions. On that point, next page, U.S. rate cuts are coming, as I said today. The market is pricing in a 100% chance of a 25 basis point rate cut and about a 60% chance of a 50 basis point rate cut. So we'll see what comes at 2 o'clock. Other central banks have already been cutting rates. The ECB cut twice now. The Reserve Bank of Australia cut twice as well, and the Bank of Canada has also reduced rates. Tomorrow we have a decision from the Bank of England. They've cut once, likely on hold for tomorrow. We also have the Bank of Japan on this Friday. They are in a different situation where they're coming off incredibly low rates, negative 10 basis points for about 7 or 8 years. They've actually hiked rates, so they're in a different cycle. And we can see evidence of that in the next slide. You can see up top, the Fed rates are targeted rates 5.25%, 5.5%. They've already come down at the Bank of England once. They're probably going to come down again later in the year, perhaps in November. And the ECB, as I said, is cut twice at this point. At the same time, the Bank of Japan in the bottom in purple have actually raised rates again as that economy continues to do well. Inflation's under control. And again, coming off those very, very negative, very, very low interest rates, official interest rates. On the next slide. As short-term rates are expected to come down, a lot of people have money in money market instruments and primarily T-bills, for example, money market funds. As those rates are expected to start to move lower, people are shifting their assets to bonds. So we see a lot of flows into bond ETFs at the retail level and an extension of duration by investors generally. The yield curve on the next slide is actually disinverted or is in the process of disinverting. So it's still inverted if you look at, say, the red lines on the top of that chart, meaning that very short rates, we still have T-bill rates above 5%, actually a little below that now, given the expectations for the cut today. But when we look at the yield curve and we look at 2-year treasuries relative to 10 years, it has disinverted. It's more of a positively sloped outcome. And you can see what a positively sloped yield curve looks like. The one in blue on the bottom, that's what a yield curve should look like, where you get paid a premium for taking on more maturity exposure and interest rate risk further out the curve. On the next slide, a quick look at where we were this morning. As I mentioned, the curve 2s to 10s have disinverted, so it's becoming more normalized with U.S. Treasury 10-year yields. This morning we're at 368. 2-year yields at 362. So again, you're getting paid a 6 basis point premium for taking on another 8 years of duration risk. Again, that's in the face of the expectation for rates moving significantly lower. On the next slide, just to look at what the inverted yield curve looked like. It's the longest inversion in the history of U.S. capital markets. At its peak, we saw 2-year Treasury yields 110 basis points above 10s. Again, a pretty significant inversion, although it was even more significant, not necessarily as long, but a higher level of inversion in the 1980s at over almost 200 basis points. Let's skip the next slide, Kate, and go to credit spreads. Credit spreads right now are pretty well maintained. In orange, you can see the high yield spreads at about 316 basis points over comparable treasuries, and that's what you actually earn in your high yield investments. And investment grade. Higher credit quality, lower spread at about 100 basis points above comparable U.S. treasuries. The other thing to note here, however, is if you can squint at the far right-hand side and look at what might be August 5th. We had a pretty dramatic sell-off in equity prices and bonds and credit in particular on August 5th associated with a yen carry trade unwind. And you can see that little spike of it's more clear in orange, and then a reversion back to where it was as the markets calm down. On that note, we have to remind ourselves that the summer officially is really not yet over. We have another couple days. It does feel as though summer vacation has ended. We came back to the office on Tuesday, September 3rd, and U.S. equity prices were off 3%. Bonds had a significant rally associated with an expectation that perhaps the Fed is behind the curve and perhaps we are moving into a recession, and started to price that in. So bonds went up in value and yields came lower. And lastly, energy prices. Oil actually sold off 8% in one day 2 weeks ago. WTI slightly, or West Texas Intermediate crude, is slightly above $70 a barrel today. It was over $80 a barrel in July. On the next slide, getting a little more into some of the meat of the discussion, the returns you're seeing for benchmark returns in 1 year, that's the fiscal year ending June 30th, 2024. That's the full fiscal year 2024. So again, U.S. stocks have had a wonderful recovery following the deep declines in 2022. Last year was positive, and 2024 positive as well. The Russell 3000 on top of the chart, you can see for 1 year is up 23.1%, and that's great, and we hope that that continues. It's very unlikely that it will continue. So on the far right-hand side, you can see the expected returns. Those are actually the average of the 5 general consultants for the 5 New York City pension plans, including Callan. So the average expected return over the next 10 years for U.S. equities is just 6.7% versus the 23% we had last year. And if you look at this, we want to make sure we don't draw the conclusion that we shouldn't even be in private equity. Private equity had a 5.1% return. We can earn in public with more liquidity, 23% returns. So, and I'll talk about this a little bit more in a moment when I touch on private assets and your actual performance. But Anash and his team have an expectation around 12 to 15% net IRR returns for private equity. And you have to compare that to what are, I think, reasonable estimates for normal returns from public equities at being about half that. With that, maybe the next slide, just more evidence of that. The thing that I take away from here is you can see on the left-hand side, you know, the charts that reflect equity returns, and the market's repaired nicely from the 2022 lows. That's both here, developed market ex-US and emerging market equities. The striking thing on the slide on the right, which Dan Haas has actually circled so we can all see it, is that that's the return of the Bloomberg Ag. Typically, bonds historically provide positive returns on average. So what we saw in 2022 and 2023, and that significant downdraft was not necessarily typical and was a little bit unusual. And I think if you look back to where 10-year Treasury yields were pre-pandemic, at one point they were about 67 basis points. 67 basis points for 10-year U.S. Treasuries, and obviously they had gotten up to over 5%. So a normalization. We hope that those yields will continue to power the performance and generate returns for the portfolios longer term. And again, I think that we're getting back to a more normal circumstance, and we still are in that process. On the next slide, I touched on a little bit this yen carry trade. That's just a fancy way of saying that people that borrowed in yen because it had a negative interest rate, actually when rates started moving higher, they started to unwind those trades. They borrowed in yen, they swapped into other currencies, and they invested in things like mega cap stocks here in the US and NVIDIA and other things. So that certainly was reversed to some extent on the 5th of August. The other thing that's noteworthy about the 5th of August is that it was the highest change in the VIX, which is an indicator of equity market volatility. It went from about 14 to 65 in 1 day, a real big move in a very short period of time. The good news, however, is if you go ahead to the next slide, it all ended well. So you can see we had this tremendous spike down on the 5th of August and a recovery where all 3 of the main indices here, the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite Index, all wound up in positive territory for the month of August. So a bout of volatility. I wouldn't be surprised to see that there's perhaps another leg as this yen carry trade continues to be unwound, but we'll keep watching for that. On the next slide, I mentioned that you saw a disruption in equities. Well, you also saw it in BBB investment-grade corporate bonds. And you can see, again, Dan Haas is circled in red on the far right-hand side. That's spiking yields that went from 115, 110 basis points up to about 129 basis points and then came right back down. So a short-lived disruption in the market that reminds us all that we need to pay attention to volatility and that there are benefits associated with having a diversified portfolio. Now, this next slide is a little more controversial. It's food for thought, where we talk about the level of indebtedness of the U.S. government and other sovereigns around the world. And we have to remind ourselves, when we look back at the strategic asset allocation review that we did, our main inputs for that are backward looking. We look at over the last 25 years and get a sense for what were the average level of asset returns, what was the average level of volatility measured by standard deviation, and what were the correlation of those returns. The one thing we know with certainty is the next 10 years are going to be different than the last 25 years. The last 25 years are also noted by having dot-com bust, the global financial crisis and all that entailed, European sovereign debt crisis, a pandemic, a spike in inflation associated with the pandemic around the world, and now a ground war in Europe with the Russian invasion of Ukraine. So we look ahead and we figure out what are the things that are going to be drivers of the economy and markets, and we look for those things that are going to have an oversized impact on GDP growth here and abroad, inflation here and abroad, productivity, public spending, and private investment. And when we look at a number of things, we look at the decarbonization of the economy, the impact of climate change. We look at things like demographic changes, and I'll talk a little bit more about that in a moment, but the impact on labor force dynamics. We look at digitization or transformational technologies such as artificial intelligence and try to figure out how to invest around that. We also kind of wrap everything in a geopolitical risk wrapper to get a sense for where we think things are going. This actually touches on the level of debt, sovereign debt outstanding and the sustainability of that. So if we look on the next slide, Kate, if we look at where we are, again, there's a lot of information on the slide, so I'll actually read some of the highlights. Right now, U.S. debt relative to GDP on an annual basis is about 97% of GDP, very, very high levels. Our deficits are projected to be at least $1 trillion a year for the next 10 years. The current deficit spending at the current rate is $1.9 trillion this year. We have $9 trillion of government debt maturing over the next 12 months, which means lots of recycled supply coming to the markets. U.S. buyers are households, pensions, and insurance companies are big buyers of U.S. treasuries. We have a significant amount of treasuries outstanding right now that are very short-term in their T-bills at 22%. Historically, it's between 10 and 15% at its top. So obviously, to meet supply, a lot of issuance in T-bills. As rates come down, that may reduce the burden of the expense associated with that on the Fed to some extent. 2024 increased auction size of 24%. Sorry, beg your pardon, 27%. Our debt servicing costs today have gone from $1 billion a day to over $3 billion, which is really quite significant. And our debt servicing cost is currently 12% of our government outlays, or slightly more than $1 trillion a year just in interest expense associated with that. So what does this mean? So we look at the bottom. What are the things that we should keep our eye on? Treasury auctions. We look for fat tails. We look for some sense of challenge in terms of the Treasury issuing new debt and how those auctions clear. Right now, they've all gone well lately because the U.S. Treasury has been rallying as markets expect rates to come down, official rates to come down, and perhaps the Treasury market's pricing in an increased risk of recession. We also look at rating agencies and perhaps how they may respond. We still have a AAA rating from Moody's rating service. S&P and Fitch both have us rated at AA+, and we'll see if those are subject to change. And the last and perhaps the most important point, and the reason why I've gone through this long explanation, is the term premia. And that means basically how much yield are you getting paid to take on risk associated with buying treasuries out the curve. And I believe that yield premia is likely to be expanded at the margin over time. You can look at swap spreads and make an argument that it's already impacting our expectation in terms of where Treasury yield should be further out the curve. So something to watch. I think that a higher level of base rates, if you want to put it that way, will benefit pension investors generally by providing, again, more yield for the portfolio over time. On the next slide, maybe
Steve,
sorry, John, please.
Could you relabel that 10 fun facts? I mean, I think from a presentation standpoint, it would help us a little bit more if we consider those fun facts.
I'm trying to make it light. There's nothing funny about this situation.
Yeah,
and
no.
you know, the markets tend to focus on macroeconomic developments. At some point, they may shift or toggle over to fiscal developments. I think this bears watching. Listen, I'm also aware that the U.S. dollar is the reserve currency of the world. Having said that, we were 65% of global reserves in 2010. We're 57% today. So there has been some reduction in the amount of reserves that are being held abroad. I think that the U.S. Treasury and the United States government's taking possession and control of Russian balances in dollars at independent accounts was a challenge. I don't know that it's necessarily bad policy. I'm not in a position to make comments, but I do think that concerns some investors that would buy treasuries like China, Turkey, Iran, others that would recycle their debt generally. So I think those things that merit watching. On the next slide, just a look again, the interest expense. You can see how it was about $1 billion a day. It's over $3 billion of cost today. Let's pivot to something perhaps a little more positive. This actually touches your portfolio in a number of ways for a number of reasons. This actually is, again, food for thought. It looks at the data centers in the States. We have more data centers in the United States at about 5,381 relative to the rest of the world. Obviously, data centers are very important in terms of processing and storing information associated with the cloud, but more recently, and perhaps more importantly today, artificial intelligence use. But it is interesting to see that the data center buildups are significant. We have data center exposure. I should say you have data center exposure in your portfolio through infrastructure investments. You have data center exposure through real estate investments. You have some residual exposure to data centers through private equity. So this tells me a couple things. First, you have to ask, well, is the U.S. overdone in this area? And given our expectations for artificial intelligence and demand for processing power, I don't think so. So it probably begs the normal question, well, why isn't everyone else investing as heartily? And I think that you'll see an increase in data center investments over time. I know that Petra and Blair and George and Jonathan are very thoughtful about how they position the portfolio, the ideas that they bring for the trustees for consideration. So we'll probably see more data center investments outside the States. It's also interesting to note that the data centers that Petra and Blair have looked at and actually recommended and you've approved, some of them actually have sustainable forms of energy that actually feed the data centers. An AI search relative to normal cloud search uses between 10 and 20 times the amount of electricity. So a lot of demand for electricity, a lot of demand for increased processing power associated with artificial intelligence. Maybe a pivot. One of the things I touched on earlier is those macro themes that will impact the markets over the next 10 years, we believe is deglobalization of the economy. This is a slide that actually shows some evidence of that in terms of an increase in our manufacturing capabilities here in the States associated with the CHIPS Act, the Inflation Reduction Act, and the Infrastructure Act. You can see there's some positive on the far right-hand side. And we expect that to continue as we I wouldn't say decouple, but strategically think about our supply chains and where we're producing product. On the next slide, I talked earlier about demographics. We got a lot of old people, I'm one of them in the United States, that are getting closer and closer to retirement age. That will impact a number of things, the spending patterns, the demand for housing, et cetera. Let's focus on China, though. They have even more of an extreme issue around demographic challenges. The population growth in China has turned negative. It's now 2.5% negative a year. So fertility rate in China is just one relative to what it would take to replace the existing population would be closer to 2. It's 1.6 in the States. In Japan, it's 1.2. The working population in China, there's about 1.4 billion people. About 1 billion of those are working age or able to work. Working age population is expected to decline roughly 100 million people every decade. The population of China at its current rate is expected to go from about 1.4 billion to under 700 million people by 2100. So again, really significant changes there. I saw an interview on Bloomberg a couple weeks ago that talked about this dynamic, and the suggestion was made that perhaps robots will be used to replace labor. I suspect there's some truth to that, but again, those certainly bear watching and thinking about. The next slide is just a chart that shows the negative rate of population growth in China, again, at around negative 2.5%. On the next slide, related, it looks at India versus China in terms of earnings per share growth. India's actually outperformed China quite significantly. You can make an argument that the valuations for India have gone up too far too fast. But again, it's worth noting those two economies are decoupling in terms of their earnings potential. I suspect we should listen to that. I offended someone in India or China. Kate is our security warden for the Bureau of Asset Management. No, she's not. Okay. Okay, we'll wait to hear an all clear signal at some point, but yeah. Well, it seems to indicate it's not a real emergency. It's perhaps a problem with the system. But we'll wait for more information. I do want and need to be very respectful of the that warning service. Go to the next slide. It's one of my favorite slides. I think we can perhaps proceed for the moment. So this is more food for thought. This is an interesting slide of the primary energy consumption from renewable sources of energy around the world. It indicates a couple things to me, that there's probably a lot more work that needs to get done in terms of the deglobalization of our economy, which will have implications for investment opportunities as well, and government spending, I'm afraid. What I thought was really interesting about this is Brazil and Norway are the standouts. Norway obviously has outstanding wind capabilities and hydroelectric power. Brazil, however, I thought was more surprising, but apparently they're very green in Brazil. They really have focused on hydropower development. They have biofuels that fuel most of the cars in Brazil, using ethanol developed from sugarcane. And they obviously have great capabilities in wind and solar as well. So an interesting tidbit there. We do see that 12% of the energy consumption comes from renewable sources in the state. So obviously, as we need to and are moving towards a decarbonized economy and less reliance on fossil fuels, there's still a lot more work to get done. There's a lot more spending associated with that and a lot more investment opportunities, I think. On the next slide, kind of touching on the same theme, this is really interesting. You look at the amount of wind and solar projects under construction in China. They are the outlier, as much as the U.S. was outliers in terms of its data centers around the country. Look at that. I mean, China has over 338 projects underway, which is more than the rest of the developed world combined at this point. So obviously, they're making significant investments into those greener technologies that I think will certainly be positive. Now, maybe moving one more slide, Kate, to get into the meat of the presentation and the discussion, and where it's most important is in terms of how your portfolio performed in the fourth quarter of fiscal year 2024, second quarter of calendar year 24. Great. Well, following on that good news, that the building isn't on fire, actually, if we look at the one-year returns on this slide, these are actually NYCERS performance for the full fiscal year 2024, which was a great outcome. You have a 7% actuarially assumed rate of return target, and actually you produce a 9.9% return. So hats off to the trustees for the decisions they've made that contributed to that portfolio. As the CIO, I love it when people say you're doing a great job, you've outperformed now 2 years in a row. The real truth is, the decisions that we're making collectively right now as trustees and as the Bureau of Asset Management from a recommendation standpoint, they really will have an impact on the portfolio in 5 and 10 years down the road, particularly as it applies to private equity, private assets, private equity, infrastructure, et cetera. But it's nice to see that collectively that the decisions that have been made and the position of the portfolio have generated, again, that positive return over and above what was expected and hoped for. The other parts of information that's on this slide that sort of indicates underperformance, which is not really true, is the NYCERS policy return. So if you were at your new strategic asset allocation, your return would have been slightly higher. It's hard to argue that private assets would have benefited the portfolio this year when public equities just had such a killer year. But you can see those other metrics as well. If you were just in public markets, you would have had a superior return. Again, we can't expect to see 23% returns on the Russell 3000 consistently going forward. It's nice to see, but it's not a reasonable expectation. On the next slide, it's kind of an interesting way that Dan Haas is designed to show your performance in orange or we call it as burnt orange relative to that 7% target. So you're pretty much right at that target for the last decade, and expectations are for us to continue on that trend and hopefully improve on that trend. On the next slide, a look at NYCERS net public market returns. As I said, U.S. equities, Russell 3000 up 23+%. Your returns were actually for the fiscal year 2024, 23%. It's nice to see a lot of green in that one-year column. Developed market ex-US, 8.4%. Emerging market equities up 15.9%. And fixed income that's actually had a more challenging couple of years, again, coming off of the spike in rates and the decline in prices in 2022 and 2023. It's just nice to see a recovery in the last fiscal year. High yield delivering 9.9% returns, convertible bonds 6%, and then cash a little under 6%, again, associated with those official rates being much higher. On the next slide, a look at your excess returns and basis points for public market investments. U.S. equities, again, for the year came in 15 basis points below what the Russell 3000 delivered. A pretty good outcome because of the outperformance of the Russell 3000. It's hard to keep up when a rising tide is lifting all boats. You can see, though, that there's more work to be done in our U.S. equity allocation. If you look at the curve out 5 years, we've delivered a negative return relative to that benchmark. So that's one of the things that John Mercerberg and his team and others will be looking at soon. Developed market ex-US obviously struggled a little bit in the 1 and 3 years sector. That had to do more with some of the managers you have in your current stable and a move out of growth and a sell-off in tech stocks here and abroad. So again, a pretty good outcome notwithstanding. On the next slide, just a pictorial representation of your public market returns. I mean, we're trying to be a little more creative in terms of how we present these things. So of your $88-ish billion portfolio, which is really just a wonderful amount, public market assets are about $65 billion, and you can see them charted on the left in the pie chart. And on the right-hand side, a different look at performance. So darker is better. Those are your returns relative to the benchmarks, which are in lighter colors over different periods of time. So a creative way of actually showing the performance, outperformance or underperformance by asset class in the public sector over time. On the next slide, and we promise and endeavor to do more on this to provide more insight into fees and how and to demonstrate to the trustees what we're consistently doing to reduce fees in public and private markets. Here you can see that your second quarter calendar year 2024 fees were about $24.5 million. If you multiply that by 4 times and annualize it, it's about $98 million worth of annual fees. Your average fee for public market management on the far right-hand side in dark gray is 16 basis points, and we will continue to work on moving that lower. We need to be focused on that every year to go back and reevaluate what we're paying. Are we getting value for money? I know that Ed Berman and team have done some great work in terms of trying to calculate the excess returns we're receiving per basis point of fees, or alpha for fees. So more to come on that. It also would empower us to have more of an informed dialogue with our managers in terms of what share of the benefit that they're generating are they keeping relative to what we're receiving, and maybe use that as a means of negotiating fees lower. On the next slide, let's pivot to private assets. These are your net returns in private assets. As I said, private equity, a little bit of a challenging year. Distributions are lower. There's still a difference between the bid-ask spread in terms of where buyers want to buy and sellers want to sell. And general M&A activity has been a little on the lighter side. Again, a tough comparison relative to where we were in public markets. But again, as I suggested, and I saw Anash walk in a few moments ago, Anash's expectations for private equity are 12 to 15% annual IRRs over time, relative to a 6.7% average expectation for public market returns. So we're completely confident in the asset class, and I do think, and Anash could talk more intelligently about this, I do think it's a great time to continue to put money to work in those strategies. Real estate, core, non-core, really challenged a little bit, delivering a negative return. That's office, and I'll show in a moment how we've actually outperformed the Odyssey Index by being underweight slightly office and overweight multifamily, industrial logistics, self-storage, and medical facilities, which again is advantaged the portfolio. But again, it's a negative return, so that's still challenging to swallow. Other than that one challenging outcome for this year, it's nice to see green across the board. As I said earlier, we shouldn't be focused on one-year returns anyway. We should be focused on 10-year returns. So if you look at by asset class and privates, 12.4% on average for 10 years for private equity, 8% on average for real estate, core, non-core, 11.9% for infrastructure, which has been steady Eddie in the portfolio, and again, a real benefit for performance. And alternative credit, I mean, coming off those very, very low levels of official rates, a lot of these obligations are floating, just 6.8%. But again, if you look in the performance in 1 year, that reflects higher base rates and spreads that were wider and then subsequently tightened. Tina and her team have delivered a 12.2% annual return for last year. A look at NYCERS net private asset excess returns. Again, as I mentioned up top, private equity, it's a tough year to be compared, tough 2 years really to be compared to the Russell 3000. This also has a 300 basis point additional kicker, perhaps an illiquidity premia that is expected to be returned from private equity. So the outperformance there has been challenged only because of the significant rally coming off of a very challenging 2022 for public markets in the last 2 years. And again, some sluggishness on private equity as that market kind of reloads and reprices, and things are, again, widely expected to pick up in the coming months. And as I said, office is outperformed by 730 basis points in the 1 year sector. Again, that's that underweight to office relative to other things that have performed quite well. And I know John Glusak is working with Petya and DCO Gagella just in terms of, does that underweight in office still make sense as the market starts to bottom out? We may want to think about just strategically how do we position for that. On the next slide, I'll look at your net private manager return summary. Again, private assets right now in the ground, you've got about $21.7 billion at work. As I said, private equity is a tough comparison relative to the Russell 3000 plus 300 benchmark, given, again, the significant outperformance of public markets coming off of those challenging downdrafts in 2022. On the far right-hand side, though, if you look at infrastructure and alternative credit, and every year, that dark line is bigger than the slightly lighter, similar colored line. And that just represents that we've actually outperformed your benchmark. I should collectively, those assets have outperformed your benchmarks consistently in all manner of time, 1 year, 3 year, 5 year, 10 year. and since inception of the portfolio. So a good outcome there. On the next slide, again, kudos and hats off to Dan Haas, we're trying to provide more insight into your portfolio positioning. This is just a fancy way of looking at your private market exposure today. And if you look in the top middle column, that's actually money that's at work, that $21.653 billion. That's money that's actually at work and in the ground today. You've also looked at, reviewed, vetted, and approved additional investments that are committed but not yet called to the magnitude of $10.83 billion. So in aggregate, you have an exposure of 32.4. And if you look at that, you're going to scratch your head and say, wow, off of a base of 88, it looks like I'm over allocated. But it's a dynamic process. So as those assets continue to repay or kick off returns and mature, that's why we have a 5-year pacing plan in terms of how we look at things and put money to work for vintage year diversification, but also realizing that these portfolios continue to be both calling capital as well as delivering capital back, hopefully with nice, healthy returns. Last slide before I turn it back over to Mr. Dorsa is just a look at your rebalancing activities. So we fully rebalanced your portfolio into your new strategic asset allocation in public markets in the fourth quarter of fiscal year 2024, the second quarter of calendar year 24. And you can see evidence of that we actually sold out of tips, and we were buying high yield, for example. We actually raised money for cash, and we were divesting from certain equity markets to raise money for other things. The portfolio won't be at your strategic asset allocation. I suspect it never gets there because it's a dynamic process as we review strategic asset allocation every 3 to 5 years. But again, for, say, private equity, we have a 5-year pacing plan, and it takes time to prudently get to that exposure that you've asked it to get to over time. And at the same time, your portfolio continues to pay down. Again, that's the importance of the pacing plan. And with that, I'll open up to questions. I know I tried to cover a lot in a short period of time. Are there any things that I should add to or?
Larry?
Yeah,
see that you
I
have a
would just
question.
ask one question. There have been discussions about credit and the fact that rates will be coming down and that it'll affect credit yields, and that everybody and his uncle has a firm has a credit side. Are we in any trouble dealing with the number of people that are involved in credit and what will happen to that market as it shakes out?
Yeah, that's a great question. So obviously with the issues that regional banks have had and banks have had in terms of pulling back from extending loans, it's actually fueled the ability for private credit to be a more viable asset class. As you know, Larry, we're not strategic. We're not tactical. We're always strategic. Our exposure to alternative credit or private credit is core, and something that, again, with your approval, we're increasing exposure to that over the course of time to, again, pacing plans. There has been a lot of interest and a lot of people hanging a shingle out saying, we're really good in private credit, come over here now. We obviously have focused more on those tried and true managers, the Ares of the world, the Apollos of the world, the Oak Hill Advisors in your portfolio. So I think you're in actually very good position. Many of those mandates that you've approved that are in your portfolio are also somewhat flexible. So I'll give you an example. 70% of your assets in private credit are really in separately managed accounts. And a lot of those are multi-strategy, which means that the managers can toggle in and out of public and private, more private, but they can look for the relative value of the cheaper assets and position accordingly. So we're not tactical. We want them to be tactical, and I think the portfolio's been well positioned. I think Tina's been very thoughtful and worked very diligently in terms of putting the money to work. I know that Anash in particular and Pecha, the DCIs, have spent a lot of time on all of the private asset classes, making sure that we've got proper risk controls in place, we're getting good value for money, that we are making investments that are not too overly aggressive and at the wrong time. So for example, focus on first lien, super senior credits versus second lien or further down the waterfall in the event of a bankruptcy. So I think we've been thoughtful. I think we've been deliberate. I think the partners we have are compelling. And I think that Tina, again, working with Anash and Petya, have done a really good job of forcing fees down. One of the things that I don't think we do a good job at presenting, but I think we do an excellent job at actually accomplishing for the portfolios, is getting the fees down. And ultimately, fees are going to have a big impact on the portfolio's performance. We saw in public markets, your average fees are 16 basis points. Private markets, it's significantly higher. But I would say, as you look at the money that's being put to work today and the performance over time, the fees are coming down for a couple reasons. I think Anash, Petya, John, and Tina have done a really good job of being disciplined in terms of negotiating fees lower. The dynamics for private equity in particular are just really interesting at this point because the asset class, the distributions are lower. A lot of people are full up on private equity. We're really in the catbird seat. We're able to negotiate better terms, get access to better managers, to get a significant and healthy dose of co-investment, which actually is no fee, no carry, that really reduces the costs over time. So as I said, I was joking earlier, but I was somewhat sincere that a lot of the good work we've done over the last couple of years since I've been here, you really won't feel or see in the portfolio for a while, but it will have a material impact on the return, the net returns over time, based on the good opportunities we've taken advantage of today. But private credit, you're right, Larry, as rates come down, the returns will come down, but you still have base rates. So I don't think we're getting back to a zero-bound interest rate. It's hard to say. I don't have a crystal ball. I do think that the terminal rate of Fed funds is probably closer to 3%. It's versus zero. So I think that extra 300 basis points provides a buffer. And if there is a credit disruption, you'll see credit spreads widen, and you get compensated for that as well.
Thank you.
Sure. Any other questions?
Any other questions? Okay, seeing none, I believe that concludes the public agenda. I just want to note for the record that this is a joint meeting and that BERS trustees are welcome to participate. However, I do want to note that they'll take up the business as they don't have a quorum at their next meeting. And I'm not actually sure if there's any BERS trustees besides myself participating in this meeting. And if they are, we ask that they just make themselves known for purposes of the record. But if there's no other business, I'd like to make a motion that we exit public and enter into executive.
Second.
Okay, so we are now in executive, all in favor?
Aye.
Okay, so now we are in executive session. I would ask that the cameras be turned off. I would ask that any chorus of ayes. So Ms. Winery, if you'd like to report out.
The board agreed to invest in 2 private equity and 1 alternative credit investments. The details of these transactions will be released at a later date.
Great, thank you. And with that, I'm going to make a motion to adjourn.
Second.
So, yeah, so moved and second. So, aye, chorus of ayes.
Aye.
We stand adjourned. So